Sunday, July 25th, 2021, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at a subject that is very much in people's minds, especially people who watch this channel, especially people that own gold, especially people in the UK. In the UK, house prices are almost like a religion. People talk about house prices in every kind of social setting. You read articles about people, especially in the Daily Mail, and they put the value of the person's house in the story. It's really something that is a bit of a national obsession. So I wanted to look into that. I have looked into that in the past. Recently, probably a year ago, I used to look at it even before I started this YouTube channel with colleagues at work back in the before the great financial crisis. We looked at the ratio of gold to the house price, average house price in the UK. So that basically means how many ounces of gold you need to buy the average house in the UK. Yes, London is a different kettle of fish. The prices of the average London house price are kind of double the average of the whole UK. Before I start, though, I've crunched a lot of numbers. I've got some interesting charts. I want to say that historically, let's go back to 1914. And why 1914? Well, prior to 1914, prior to the start of the Great War, as it was called, prior to World War II, of course, the pound was this here, was a sovereign. It's a gold coin. As you can see, it's about 0.2354 of a troy ounce. So that was a pound. We need to keep that in mind. The pound today is something completely different. It's a little piece of copper nickel coin that has very little intrinsic value. So I would say, even though the name of the currency nowadays is the same, pound sterling, it has nothing to do with what it was in 1914 or even 1952 or 1970. The pound is constantly changing. Unfortunately, it is supposed to be a measure of value, but it's not constant. And yeah, it's just like changing the measure of height, of weight, of distance. It would be a crazy world. And that's what you need to keep in mind about house prices, that it's a crazy world because we don't have a fixed weight of value like we had prior to World War I. So, wanted to share first a little bit about the UK housing situation. And for that, I actually found something on Wikipedia, which is quite interesting. Just give me a second here. Because housing as well is not the same today as it was, for example, during Victorian or Edwardian times. So it says here, housing in the United Kingdom represents the largest non-financial asset class in the UK. Its overall net value passed the 5 trillion mark in 2014. About 30% of homes are owned outright by their occupants, so no mortgage. And a further 40% are owner occupied on a mortgage. About 18% are social housing of some kind, and the remaining 12% are privately rented. I also wanted to look into ownership. As you can see here, ownership. Increasingly, the British ideal was home ownership, even among the working class. Rates of home ownership rose steadily from 15% of people owning their home before 1914 to 32% by 1938 and 67% by 1996. I think that proportion has dropped a little since 2008. It's probably, I don't know where it's down to, but it's less than 67%. So I wanted to point out, of course, that house prices have been affected by the fact that more and more people through the decades have aspired to buy their own home. So that has put, I would argue, some kind of bid into house prices. I also just wanted to show you London house prices, how much they are worth, the average house price, 497,948. That was as of May this year. So almost 500,000. Keep that in mind because the data I got is for the whole of the UK. So 497,000. So now I wanted to go through what I did, a bit of research, a bit of number crunching, on my spreadsheet here, my iNumbers spreadsheet. It's not a Microsoft Excel. So you see all the data here that I've amassed. So we've got the gold price, latest fix at the end of the year. Why the latest fix? Well, because sometimes there is no PM fix on the last day of the year. Sometimes there are, so I've had to take the AM fix. It doesn't really matter. And this is all in British pounds, of course. And as you can see here, from 1952 to 1966, the price of gold was always the same, £12.50. Well, that's because the price of gold was fixed at $35 an ounce. And the exchange rate between the pound and the dollar was fixed as well. In 1967, in November, there was a devaluation of the pound. So the price of gold went up to $14.58. After 1968, the price of gold basically on the international market, the London market, went floating. So you can see that the price increases. So that data I took from the LBMA. I took the nationwide UK house price, average house price, all houses, all kinds of houses. So it has data going back to 1952. You can see there the average house price in 1952 cost £1,891. And I'll scroll down here. The latest number for the second quarter of 2021 is 242,709. Of course, that's about half of the London average house price, as we saw just a few minutes ago. And then I did how many, the average house price to gold ratio. So troy ounces of gold needed to buy the average house price. As you can see, it was in the 150s back in 1952. We're going to look at the charts in a minute. Right now, the latest one is at 190. And I thought it was important to look at the Bank of England base rate at year end. They've only got data to 1975. So prior to 1975, I actually found some data from the Federal Reserve, actually, of UK Treasury discount bills. So all these rates prior to 1975 are the UK Treasury discount bill rate. And then on the right-hand column here, that's just the same as the average house price to gold ratio. And I did it in terms of 1 pound of gold. Well, you might ask, what is that? Well, it's this here. It's a sovereign, and I'll explain why it's a pound of gold. So that will actually give us an idea, because I've taken some information about house prices back in the early part of the 1900s. So you'll see why. Before we look at the charts, though, I just wanted to show you a little bit about the gold sovereign and why I said that is a pound. So let's look at why this is still a pound today. And you might say, well, that's crazy. A pound is this little copper nickel coin. Well, think again. As you see here, the sovereign is a gold coin of the United Kingdom that has a nominal value of £1 sterling. So here you go. As a legal tender coin, the sovereign is exempt from capital gains tax for UK residents. So there you go. It is strange, isn't it? That that is a pound, but so is that a pound. What I'm trying to say here, yes, things are confusing, and that's why many people don't even realize that this is still a pound, that you can save it, and there's no capital gains tax on it. So let's get to the interesting part that you're probably waiting for the charts that I've built here on my iNumber. The first chart is basically the gold price. I guess it's an annual chart, except for the last part here. I've put the price of gold at the end of June this year, because the latest data for the average house price is also at the end of June, or the second quarter. But as you can see, the price of gold was fixed till 67, really 68 at 1250 or just above that. And then it went floating and has been going up ever since. Yes, in the 80s and mid 90s, the price of gold was pretty much in the range. It did go down a little bit there in the mid to late 90s. But basically, we were pegged between 200 and 300 pounds per troy ounce. And it was around 2005 and 6 that it started taking off. As you can see, we got up to above 1,000 back in 2011. And these are not intraday prices. This is just at the end of the month. The all-time high might be higher than this level. And then we had the big correction up until 2015, and it's been going up since then, end of 2015, as you can see, and it's kept going up. So it's been a constant rising of the price. And why is that? Well, because up until 1914, a pound was this. So every a pound entry that was created in loans had to be backed basically by one of these. Of course, I think there was a bit of fractional reserve, and historically in the Victorian times and up until World War I, the British banking system had about a third to 0.4 to 40% of gold backing. So the money was quite sound. I recommend you go onto the Bank of England inflation calculator and go to 1814 or 1821 to 1914, and you see that the value of the pound didn't change during that period. That's when money was a measure of fixed weight. So now we've got the nationwide average house prices, and they've basically been doing fairly similar to gold. And you notice as well that ever since Nixon closed the gold window back in 1971, that both of these measures of prices, gold prices and house prices, have kind of taken off. Everything was pretty steady prior to that. Ever since then, with bankers and politicians having almost no limit in how much they can borrow and issue in terms of credit, this is what's happened. I'm going to show you as well here the Bank of England base rate. And this is really important, in my opinion, because As you can see here, around 2006, 2007, that rate topped here. I think it was just above 5%. Not too sure. Let's have a look. I've got the data here. Yeah, it topped around 5.5% in 2007. And ever since then, it's just been collapsing, that rate. And right now, as you can see, is at 0.1, which is unheard of in the last 300 years, ever since the Bank of England has been created, ever since there's been money, people lend and borrow. We basically virtually got 0% rates. And if I go back up to look at house prices, you can see that it started picking back up after rates were pushed down, and it's really taken off now. It's gone past the previous high back in 2007 house prices. And gold as well. The gold price started taking off just around that time. Yes, it broke through that 300 level back in around 2005 and 6, but it really took off when interest rates started going down. So I'm going to come back in a minute to what I think this interest rate policy here, as you can see, how it will affect house prices and gold prices. So now to the interesting part here that you've probably been waiting for, the average UK house price to gold ratio. So it's troy ounces of gold needed to purchase average house at year end and end of June 2021. So the higher this ratio is, so the higher the chart goes, that means the more gold you need to buy the average house price, the more overvalued house prices are versus gold, and vice versa. So if we look back to 1952, what happened in 2004, because this ratio topped in 2004. As you can see here, 2004, the price of gold was still around 220 or 230 or thereabouts, and house prices had gone up quite a bit. They're still just above 150. But in terms of the ratio, they were above 650 ounces. So in the last 70 years or so, that was really out of whack. It was outside the normal range, so to speak. It was really the best time really to sell houses and buy gold. So right now, we're pretty much in the middle of the range that we've had in the last 7 years. And that's if you take out this anomaly here. And I think this was an anomaly here. This was a bubble, the housing bubble, of course. Yes, it topped in 2004 in terms of real money, and it bottomed sometime around 2012 here, as you can see. And house prices did well relative to gold up until 2015. And since 2015, they've been going down. They've rebounded in the last 6 months, as you can see here, by the ratio. So where do I think that this is going? Well, there's two scenarios, of course. We could see this rebound, and I would say that the 300 or 250 to 300 area is probably going to be a resistance from now. Will we ever be able to get back to above 650 ounces for the average house price? You can never say never, but one reason why I put this chart up, the Bank of England base rate, is that it shows that there isn't that much more, how can I say, ammunition for the bankers, for the politicians to inflate housing. Yes, they can keep doing QE now, but can they really cut rates to negative? Will that really help housing? It could a little bit. one of the reasons, in my opinion, that they've been able to blow this housing bubble, especially since the mid 90s, is that they had room to cut rates, as you can see here. But now there's no more room. So I personally think that this ratio, yes, we could go back up. Houses could outperform gold again. But that doesn't mean that the gold price will go down, because I think what we're seeing is house prices or houses and gold detach themselves a lot more from this little coin here, or the pound that can be created out of thin air. But against gold or this pound, of course, it's going to be harder and harder. They've basically over time been very good stores of value. Sorry, gold, which is money, of course, and bricks and mortar. So the next ratio here, of course, it's the same one as this one, but I've done it in terms of sovereigns, which basically are 1 pound. And prior to 1914, everyone knew that it was a pound. Nowadays, it's still a pound nominally, but very few people know it. So right now, that ratio is you need 800 of these to buy the average UK house price, which is around £242,000. And you need 242,000 of these. So what are my conclusions about this? Well, the most important thing, in my opinion, is that one needs shelter, and preferably fully owned shelter. By that, I mean no mortgage. It's really hard to survive and thrive in the world if you don't have shelter. So I think having a house or a home is very important. What about gold? Well, gold is completely different than houses. Gold is money. So yes, houses have kind of outperformed the house price, and I'll show you how they've outperformed a bit in terms of gold or the sovereign. I've got some articles that talk about this. Do I think people should sell their houses or buy houses when this ratio changes? No, I think this is a good indication for people that have savings in real money, in sovereigns, in gold, to have an idea of where value is. So, for example, if this ratio dropped to around 400 in terms of sovereigns, and as you can see here in ounces, 1982 was the key year. It dropped to below 100. So right now we're at, let's see, where are we? The ratio is 190. 1982, we dropped to, let's see, 90.87. So 90. So yeah, compared to 1982, we're still overvalued. So who would a ratio, looking at this ratio, benefit? In my opinion, would it benefit young people in their 20s that are just starting out their working career and thinking about buying a home? I think those people should try to buy a home. I don't think they should be too worried about the pound value, even though it is risky, of course, because house prices are in these are so high right now. You need to be careful how big of a mortgage you take. But eventually, when you get older and you're able to save, I think knowing about this ratio is really important, because it could help you determine where maybe to put your savings into for your retirement. So, for example, if you see here that in 15 years' time, let's say you're 50 right now, in 15 years' time, this ratio is at 400. You know that it's not a good time probably to sell your gold, to buy a second home to rent. But if it is around 100, then yes, it might be a good time to do so. So that's how I view it. Houses, of course, are not money. Bricks and mortar, they're not as liquid. They're not as easy. You can't call the estate agent and sell it right there and get the cash tomorrow like you can if you call gold investments, for example. The people that I have my promo code with in the city of London, they're arguably one of the oldest bullion dealers in the city, family run business. You can use my promo code, of course, Monaco64. Yeah, and you can sell your gold on Monday and get your cash the same day when they receive your gold. So gold is money. So that's the difference. Where do I think this ratio is going then, just before I go further? I think it's going to keep going lower. Yes, we've rebounded this year a little bit. Houses have outperformed gold. But I think if we look here in ounces, we could eventually go back to 100. But by looking at the interest rate chart here of the Bank of England, we can see that with all the debt that this country has, not just the government, but the general public, corporations, I find it really hard for the Bank of England to allow rates, at least voluntarily, to go higher. They're going to have to keep these rates at almost zero for a very long time. And all that's going to do is going to help create more and more of these pounds. Of course, not real pounds. And that's why I think as a saver or as someone that owns houses, it doesn't really matter, because these prices are going to get more and more wacky. It's just a matter of when house prices go up quicker and vice versa in terms of, gold prices going up quicker. And as you can see here, ever since 2006-7, we've taken off. And houses have taken off as well. And even prior to that, and it's not stopping. It looks like it's going parabolic. So I try to stay out of the pound, the fiat currency, as much as possible, and stay in houses and gold. And yes, use this ratio to help you determine whether you should put some of your savings into housing, if you're lucky enough to be able to afford that. So with that, just wanted to go back a little bit here in time. It's hard to find information about houses, how much they cost back in the day. But I found an article here from The Guardian, of all papers, but they've got this article here. This is from 1999, so it's an old article. It doesn't really matter, because we're trying to find where house prices were in the early 1900s. So it says bricks are worth their weight in gold, which is weird, right? So this is what I found here. This is about house prices in London in 1900. So it says the most striking feature of the prices paid in 1900 is their similarity across the UK. London prices in the range of 237 to 300 were around a quarter higher than the 200 to 245 paid in areas such as Portsmouth and Dover, a much smaller price gap than now. Yeah, this article was from 1999. Now the price gap, London is double the value. But what I wanted to show you here is that the 237 to 300 pounds, those are sovereigns. So yes, and I know that home ownership was a lot lower then. It was about 15% of the population, maybe a little lower in 1900. And I do admit that demand for houses and the population growing as well has played into it, but I would say that it's the inflation of the currency, the fact that we now really might as well compare house prices to bananas because these things are so plentiful, these fiat pounds, right? This is a real store of value, stable value money, right? Gold, silver as well to some extent. I mean, you could buy a nice toga, a nice pair of sandals in Rome, well, expensive ones for a troy ounce of gold. And today, with a troy ounce of gold, you can still do quite a bit. So, looking at this and at the sovereign, it shows us that, yeah, the average UK house price, let's say, was 250, which is in the middle between the lowest outside London and the highest in London, let's say 250. So we can go back here to our sovereign ratio, and we'll see that, yes, it does look that historically we are overvalued, but of course there are those factors of much higher home ownership, higher population. But it makes sense that this 400 here for the UK. If we go back to 200 in that ratio, I would say that would be a screaming buy. And that's the sovereign ratio. That's not per troy ounce. Per troy ounce, that would be around just below 50, around 47. I would say that level would be a very good level to exchange some of your real money or gold into bricks and mortars. But then again, looking at this interest rate chart and what these are doing, and having spoken to people like Arpad of Starpath Academy, who went through a hyperinflation, I have a feeling we could be in the first innings of a hyperinflation. And then this ratio here could really go all over the place. We could see a lot of volatility. So ultimately, in a hyperinflationary scenario where the fiat currency is basically destroyed and there's no fiat currency out there, there's no paper money, so to speak, these become priceless and very hard to come by. So I would say we could have the opposite of what we had in 2004, where that ratio went out of whack, where houses became really expensive. We could see this ratio, of course, drop massively and gold become really expensive relative to houses. So that would probably be the best time. But barring a hyperinflation, as I said, the ratio below 100 would be probably pretty good. And the ratio just around 400 sovereigns would be pretty good as well. So yeah, let me know what you think in the comment section. And if you enjoyed this video, make sure you share it far and wide. Also hit the like button. Think about subscribing to my channel if you haven't yet. I wish you all a great rest of the weekend. Take care. Bye.